Should you do a 30-year fixed or a 15-year fixed home loan? Great question, and the exact question that Alexandra W. asked. If you have a question of your own, feel free to submit it on our YouTube channel, Facebook page, Instagram page, or our website at lendingahand.com. My name is Scott Wynn. I'm a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans, and I work jointly with my wife, Marla Wynn, and our business partner, Joe Egan. So today we're going to compare a 30-year fixed mortgage against a 15-year fixed mortgage. Now, one thing I want to be clear about is that there are different options. You don't just have 30 years and 15 years as the options. In fact, you can do a 30-year, 25, 20, 15, or even a 10-year fixed mortgage. But for today's video, we're just going to cover 30-year and 15-year, but I wanted you to be aware that there are other options available. So, first thing we want to do is look and see what the difference in interest rate is between a 30-year and a 15-year term when looking at fixed rate mortgages. The best place to do that, the most reliable and accurate source of getting up-to-date interest rates is going to be Freddie Mac's rate survey. They do a weekly rate survey of nationwide lenders to get an average so that you can get a really good idea of where interest rates actually are. To find this, just go to Google and search for Freddie Mac rate survey. Should be the first result in your search results, and you'll be able to see exactly where things are at. If we pull that up here today, what we see is that the 30-year fixed rate mortgage is at 2.88%, and the 15-year is at 2.44%. Now, of course, those are averages. It also shows you the estimated fees and things like that based on the averages that they have found. So make sure that you understand that there are some additional details associated with that. But again, for today's purposes, since the fees between the 30-year and the 15 are the same, we're going to be comparing the difference between the interest rate of 2.88 and 2.44%. Now, to do some of our calculations, we've got to know some additional details. So the other piece of information that I pulled up is the median home price in the United States right now. According to Redfin, it's currently at $311,254. So we're going to use that when we calculate our loan amount. So if we take that $311,254 and we assume a 20% down payment, that comes to roughly $249,000 as our loan amount. Let's start with a 30-year fixed. If we do the 30-year fixed at a $249,000 loan amount and a 2.88% interest rate, then what we end up with is a principal and interest payment of $1,033.75. So now we'll do the same calculation on a 15-year term. 15-year term, $249,000 loan amount at a 2.44% interest rate comes out to a principal and interest payment of $1,653.28. A difference of just $619.53. Not maybe as much as you would expect. A lot of people think that because you're cutting the time of repayment in half, that your payment would double. And that's not the case at all. In fact, this $619.53 is only an increase of 40%. So at first glance, you might think that 15-year term is way better. Not only do you get a better interest rate, but you pay it off twice as fast and your payment only goes up 40%. But there's some additional information that we might want to consider. So the first thing is that in my opinion, as a mortgage advisor looking at hundreds, if not thousands of people's finances as well as my own finances, is that my opinion is that cash is king. Because there are things that are going to happen in our lives that are unexpected, such as medical emergencies, auto repairs, maybe pet situations or emergencies. You might want to have some extra money set aside for the holidays, for gifts. Or you might want to do some traveling and things like that, and having some extra money will allow you to do that. It's all about flexibility, to be able to do what you want, when you want. And that's why I don't necessarily like a 15-year term mortgage. In fact, if you consider a 30-year term at the higher rate of 2.88%, but you were to pay it off at the pace of a 15-year term, you can actually get very similar results to a 15-year fixed mortgage, but without the requirement of having to pay that higher payment month after month after month in case one of those unexpected expenses comes up. In fact, what we find is if we take that difference, that $619 difference between the two payments, and we apply it towards the 30-year term, what we see is that we pay it off in just 9 months longer than the 15 years, and it's only $11,789 more in interest, which basically comes out to about $786 a year, or a mere $66 a month. To me, paying $66 a month is worth that flexibility to give me the option to either pay it or not pay it and handle the unexpected expenses that may come up. But there's more to this. See, I think that there are other things that you might miss out on. Let's say an opportunity cost, if you will, associated with paying your mortgage at a 15-year pace if there are other places that your money can work better for you, such as having an emergency fund set aside so in case something comes up, you can handle those unexpected expenses. Maybe setting aside money for a retirement account, or paying off some higher interest rate debt such as credit cards or auto loans, maybe even student loans in comparison to your mortgage. You might also want to be setting aside some money for a college fund for the kids. You might also consider alternatives such as investing in the stock market, where you may be able to get a better rate of return in comparison to what you would save on your mortgage. In fact, I recorded a complete video about that particular topic, about whether or not you should pay off your mortgage or invest in the stock market, which I'll share with you a little bit later. See, overall, if we consider the difference between a 30-year term and a 15-year term, what I would suggest is that you should expect the unexpected. You don't know what will occur in the future, and if you've tapped out your monthly expenses with a 15-year term, you don't leave anything extra for those unexpected expenses. You might want to consider the overall plan that you have for your finances, about setting aside money for savings, retirement, college savings, interest rate debt that is higher than the mortgage, all of those sorts of things. But also considering where you can receive the maximum benefit, whether that's paying off the mortgage and eliminating that debt, or maybe investing elsewhere. And also consider that there are other term lengths. You don't have to go all the way from a 30 to a 15. You can consider those 25 or 20-year terms as an example. So I hope that helps you in deciding what you may want to do for your particular mortgage option. So again, if you have any questions related to this topic or anything else, submit it, and we will do everything we can to answer your question as quickly as possible, and possibly even record a video just like this. So thanks for watching.